Hey everybody, welcome back to Dividend.Stockpile, where we talk about all things dividend income investing related. Today we are doing a deep dive on two intriguing premium income ETFs from Goldman Sachs, GPIX and GPIQ. These funds focus on derivatives-based income strategies. But how do they stack up against each other and other similar ETFs? In this video, we're going to talk about what these ETFs are, their investment objectives, what positions they hold, their option strategies, their distribution strategies, of course their total return since inception, and how they compare to other covered call ETFs like SPYI, QQQI, JEPI, and JEPQ. If you find value in this video, don't forget to like, subscribe, and hit the notification bell so you never miss an update. So let's get into it. So what are GPIX and GPIQ? Well, they're both covered call ETFs managed by Goldman Sachs. They aim to provide investors with monthly income by selling covered call options on their underlying indexes. GPIX is based on the S&P 500 index, which, as you know, invests in large cap US stocks. And GPIQ follows the NASDAQ 100 index, which means it focuses mostly on tech-heavy growth stocks. Both use an option strategy to enhance income, which we'll talk about later, but generally speaking, they sell covered calls on the index, either the QQQs or the SPYI, which those premiums are then collected and distributed as monthly income. Generally speaking, a covered call strategy helps during flat or bearish markets, but can, of course, limit the upside in bull markets because of the covered call limits the upside on their portfolio. So now that we have an overview of both funds, let's dig into the details of each one. All right, so here we are on Goldman Sachs website, and the first one we're going to talk about today is the Goldman Sachs S&P 500 Core Premium Income ETF, ticker GPIX. As we talked about earlier, it is an income-based ETF, and the objective, as you see here, seeks current income while maintaining prospects for capital appreciation. So the ways they do it, as it says here, seeks consistent monthly distributions. The core equity exposure is because they own the underlying stocks in the S&P 500, and the lower volatility is because of the options premiums that are received from writing the covered calls, balances out the swings in the market. And then they're going to focus on diversifying the source of income. So they use the dividends that are received from the underlying holdings, as well as the options premium to diversify the income sources. So let's talk a little bit about the details. As of the time of the recording, its net asset value is $50.50. It has 510 holdings, which makes sense if you think about the S&P 500 plus the options that they write. And looks like they've been established since October of 2023, so about a year and a half or so. The underlying is their S&P 500, and that's what they benchmark themselves at, and it is an actively managed fund. Scrolling down a little bit more to the expense ratio, as you can see right now, the expense ratio on GPIX is 0.29%, which is very good for an actively managed fund. Now, that is a temporary reduction in cost. According to Goldman Sachs, that discount is going to be at least through the end of 2025, but after that, it could go back up to the 0.35, which is their standard expense ratio. Looking at the performance, the market price is $50.55 at the time of recording, so it's just slightly over NAV, but generally speaking the same. The overall price returns have been very good since inception. Of course, the market has been generally going up as well, so that's to be expected. We'll look at the total returns of each of these funds as well as comparison to some of their peers at the end of the video. Next, we're going to talk about the distribution rate. So on the GPIX, the 12-month trailing return for the distribution is just over 8% at 8.03. So very solid, but it is kind of on the lower end of your covered call ETFs. And as you see, they do distribute monthly. The monthly distribution has been pretty consistent the entire time, slightly increases or so every month, but generally speaking, pretty much the same. So let's look into the summary prospectus of Goldman Sachs S&P 500 Core Premium ETF. Just want to talk about a couple little things here that I saw earlier. All right, so basically how it makes this money. So it invests in the underlying stocks of the S&P 500, so it owns each individual company, and then they do a dynamic options overwrite strategy. As it says here, the fund sells or writes covered calls on a varying percentage of the market value of the equity investments in the fund. It says on a normal basis, they're going to be writing 25 to 75% of the fund's value as options. So instead of writing covered calls on the individual securities, let's just say Apple or Microsoft, they're going to do call options on the index itself. And the reason why they do this is because they don't have to worry about having to sell off the positions if the calls get covered. So they're going to do flex options on the entire index, again the SPY, instead of the individual securities. So you're still going to hold all the individual securities with all the upside or downside that those particular companies have. And on top of that, they're going to do these flex options where they write calls on the SPY in this particular instance to generate that additional income. Of course, if it goes against them and they have to sell their shares, they might take a loss on the options, but they still are going to own the underlying securities. They're not going to have to sell them off if they get exercised. Okay, so now I want to talk about some of the allocation. So as you see, the top 10 holdings is exactly what you would expect from an S&P 500 related fund. Apple, Nvidia, Microsoft, Amazon, Meta, Broadcom, all the typical ones from the S&P 500. The top 10 are 36% of the portfolio, and the remaining stocks are about 64%. So again, it's going to mirror the S&P 500. You look at the sector breakdown, you can see it's pretty typical of the S&P 500 as well. But what I wanted to do is go into the details of the individual holdings. So going into the breakdown, this is from Goldman Sachs directly. You can see all the different holdings in alphabetical order. But what I wanted to do is look at the overall options strategy here. So as you see, there's quite a few options that they have on the S&P 500, the SPY, and they have it at different strike prices and at different expirations. So they have a strike price of 593 expiring on Friday the 14th, 595, 600, and then they have a 605, 607, and 610 for future dates. So this allows them to receive the premium, but also capture some of the upside in the S&P 500 over time. Okay, so as of the time of the recording, the S&P 500, the SPY, is trading at about $609.70. So knowing that the S&P 500 is trading at the 609, we can see that the call options that expired this past Friday would have been exercised. And so they gained some money on it, but they didn't capture the full upside of the market. As time goes on, the other ones will come due. And as of right now, most of them are either in the money or near the money. So if the S&P 500 still continues to go up, they're not going to be able to capture all the upside, but they were able to get up to these strike prices that you see here. Let's talk about the taxes on GPIX. Looking at the distributions for 2024, I know it's a little hard to see, so I apologize if you want to pause and zoom in. The total distribution for 2024 for GPIX is $3.68. Of that, about 70 cents is your dividends received from the underlying holdings. And if you scroll over here to the right-hand side, it looks like $2.98 is what they call non-dividend distributions. So what that is the options premium and the capital gains that they received on the investments are being distributed as a return of capital. If you're watching my other videos, you understand that return of capital for an ETF is not so bad, especially for an options-based ETF, because there are losses that they can carry forward that offset your distribution when it comes to taxes. So in this particular instance, $2.98 of GPIX is going to be considered return of capital, which is not taxable to you the current year. What it does is reduce your cost basis, and then if you do end up selling the shares at a later date, you'll owe the taxes on the lower basis. But for now, you don't have to pay taxes on last year $2.98, but you will have to pay taxes on the 0.70, which was your regular dividends. And so those are generally speaking taxed at either 0, 15, or 20%. Comparing JPIX to another very popular S&P 500 based income ETF, and one of my favorites is SPYI. You see it is a paid out monthly. Distribution rate is about 12%, so significantly higher than the Goldman Sachs product, but the expense ratio is basically double what Goldman Sachs is offering right now. So we're going to take a look at the total return to see which one makes the most sense. And also you have to consider the tax implications of each one. All right, so now let's move on to the next one. It's the Goldman Sachs NASDAQ 100 Core Premium Income ETF, symbol GPIQ. All right, so this is going to be very similar to GPIX, but again, with the NASDAQ 100 as the underlying. So objective is to seek current income while maintaining prospects for capital appreciation. Monthly distributions, like the other one, is going to give you exposure to the NASDAQ 100 as your core equity exposure. And the options writing is going to lower the volatility because of the premiums collected, can offset any kind of downside or losses in the underlying holdings. And it diversifies your income sources because it has some companies that pay dividends and also the options premiums you receive. The net asset value is $50.44, has 110 holdings, which makes sense if we're looking at the NASDAQ 100 plus some options contracts. Scrolling down, established in October 2023. Again, it is actively managed and it uses the NASDAQ as its underlying reference point. Scrolling down a little bit more, the fees and expenses, just like GPIX, this one has an expense ratio of 0.29 up until the end of 2025, where it may go up to 0.35 if Goldman Sachs decides not to keep the lower expense ratio. Overall performance, the market price is $50.42, right at the net asset value. Ever since inception, the growth of the fund has increased, but so has the market, so not too surprising. Looking a little bit farther down, we have our distribution. So right now, as of January 31st, the 12-month trailing distribution is 9.91. So that's better than the GPIX S&P 500 fund, but it still trails behind some of the other funds out there, which we'll show in a second. It does pay monthly distributions, which is good, in the low 40 cents per share over the last few months. Again, it is a NASDAQ 100 related ETF, so you're going to have all the same players: Apple, NVIDIA, Microsoft, Amazon, Broadcom, the same as the NASDAQ 100. The top 10 does have about 50% of the holdings, and the remaining 49% other companies, as you would expect from a technology related or NASDAQ 100 related ETF. Information technology and communication services are the top holdings, and we do have exposure to some of the other ones here as well. Okay, so hopping over to the prospectus, I want to talk about how they generate their options income. So we're going to scroll down. All right, to generate income, it's going to be very similar to GPIX. They're going to write call options on the QQQ instead of the SPYI, and they're going to hold the individual securities within the NASDAQ. Similarly to GPIX, this fund is going to hold the underlyings in the NASDAQ 100 and then do call options on the QQQ ETF itself. So they're not going to do it on the individual names, and they're going to use flex options with that QQQ in order to pick the details, and they also don't have to settle with securities. They can settle on cash, so you don't have to worry about the underlying shares being called away if one or two of them goes up in a short period of time. So let's now talk about the tax situation for the distributions in GPIQ. So similar to GPIX, it's going to be a combination of dividends received and options premium. If you look here in the middle of the page, I know it's small, but the total for 2024 total payout was $4.50 per share for the year, and of that, 20.8 cents of the distribution was considered dividends. So again, the NASDAQ 100, not everything pays a dividend, so it's going to be a little low payout there. But then if you go over to the non-dividend distributions, it's $4.29 for the year. So that means that the vast majority of the income that's received from this particular ETF was from the options premium. As we mentioned on the other fund, this is going to be considered a return of capital, so there's no immediate tax implications. It will reduce your cost basis, and once your cost basis goes to zero, then you would start owing taxes, but in the meantime, you're not paying any taxes on the distributions of this portion. You're only paying taxes on the distribution of the dividends themselves, which again, depending on your tax bracket, is 0, 15, or 20% for most people. Next, I want to spend a little bit of time going through the options contracts that this particular fund holds. So I pulled up the current record, and as of the date of the recording, they had about 8 or 9 QQQ options out there. A couple that had expired on Friday the 14th, and some over the next month or so. But as you can see, the strike prices are anything between $5.16 and $5.35, and you can see by the volume that they do have quite a lot of contracts out there. So they're able to collect a good amount of premium from these particular options, and they provide themselves some upside to the current market value in order to take advantage of the upswings in the market. So looking at the current price of the QQQ, which is what they write their options on, it's $538.15 as of the time of the recording. Okay, with the current price of the QQQ at $538, as you can see, all of these are actually in the money, meaning the strike prices are underneath the current market value. So if these were to expire today, they would all be called away. But the good thing is they still have some time, so as the market goes up and down, they might still be able to take advantage of the entire upside of the market. But worst case scenario, they'll get cash at these strike prices, and they'll be able to write new calls once those are done. Okay, and so quickly comparing GPIQ to another very popular one from NEOS, QQQI, which they both are NASDAQ 100 related income ETFs. You can see that QQQI also pays out monthly. The expense ratio again is about double what the Goldman Sachs product is, but the distribution rate is significantly higher at 14.02%. Okay, so the last thing I want to talk about is the total return of the Goldman Sachs products GPIX and GPIQ compared to some other comparable income ETFs. So first up, we have JEPI. So since inception, which is about 1.3 years, GPIX is absolutely crushing JEPI. Total return of 44.17% to JEPI's 27% over that time. Then looking at SPYI to GPIX, you can see that it's still GPIX is the winner at 44.17% total return to SPYI's return of 33.41. So on the surface, it looks like GPIX is doing a better job at balancing between the premiums received and the capital appreciation. In this particular instance, GPIX seems to be doing a better job in a total return, even though SPYI has a higher distribution. Scrolling over to GPIQ, since inception, it's beat out JEPQ, JEPQ, by just a little bit. JEPQ has 45.74% total return, and GPIQ has 48.96%. And lastly, let's look at it compared to QQQI. And as you see, since inception, which is a little bit shorter because QQQI has only been out for 1 year, you see a very similar return. So QQQI has 25.55% total return, and GPIQ is just trailing at 25.41%. So very similar. So to wrap it up, comparing GPIQ to the other NASDAQ ETFs, it really comes down to if you were looking at more a total return, capital appreciation bent, or if you're looking for total income. So QQQI is going to have a higher distribution, so more current income, has the potential of falling behind GPIQ on total return if the underlying holding mix and the percentage of the covered calls is different. The expense ratio of GPIQ is much better than QQQI. You have to look at the total return and the game plan of the investments to determine which one is better for you and if it's worth the extra cost of QQQI to get that higher distribution. All right, so there you have it, a deep dive on GPIX and GPIQ, both covered call ETFs from Goldman Sachs, and a comparison to some of their other peers, QQQI, SPYI, JEPI, and JEPQ. Hopefully you like that breakdown. Let me know in the comments below which of these you hold, and if you're interested in the Goldman Sachs products, or are you going to stick with some of the other ones you already have. For me personally, I'm sticking with QQQI and SPYI from NEOS because I like the higher income and I like their strategy that they use. But we'll see how each one returns over time. Again, thank you for watching. Make sure you comment below which one you like. And while you're here, take a look at the next video that's popping up. It really does help the channel. Really appreciate it. And remember, keep stockpiling those dividends.